markets rip on the back of the Fed rate hike. Let's take a look at what's going on. The Dow basically finishing flat today. The big winners were the S&P up 1.47, the NASDAQ up 3.25%, with Facebook leading the charge. A lot of analysts expected Facebook to miss on earnings, and instead they beat expectations and had some pretty good forward guidance in terms of what they expect from ad revenue, user base, refocusing, leaning out the operation, things like that. So Facebook had a nice little bounce over the last couple of days. We'll take a look at that in a second. But basically, the S&P rose to its highest level in 5 months as a better than expected Meta results further improved sentiment around technology shares. The tech sector was ripping today. All of the major tech companies were up, but major companies are reporting here soon. So we'll see how this all lays out. The gains come ahead of two big tech results after the bell: Apple, Amazon, and Alphabet 3 actually. And then Ford's going to be reporting after the bell as well. So we'll see if the market can continue to maintain the momentum. And of course, if we have good earnings reports, then obviously we're going to get a nice little bounce. But here's the Dow right here, still kind of ranging in this area of consolidation. After the Fed came out and basically said, we have more work to do, we're going to keep raising rates, but we will watch the data, and it's a possibility that they can change. They didn't say we would stop. Powell never said we'd stop. He didn't say, slow the pace or anything like that. He just said that we're going to look at the data. And the question was asked, would the Fed stop or not hike rates at the next meeting if the data looked good? And he said, obviously, that's a possibility. So all eyes are going to be on the next inflation report. A lot of the investors out there's a lot of capital on the sidelines that needs to allocate. We've been talking about that. That's kind of what's keeping the market elevated, is there's just trillions of dollars that's been pumped into the market really, since the bottom of 2020 and since 2009, that's still kind of sloshing around out there. So that capital has to go somewhere. And it's been rotating in and out of bonds and stocks, in and out of the Dow to tech sector, and just kind of rotating capital. So there's still a lot of capital out there that needs to allocate, that's going to keep markets at an elevated level until the Fed starts reducing liquidity from the market, selling, reducing their balance sheet, selling treasuries, selling mortgage-backed securities, which they have not discussed, have not really talked about. When they do that, that will take a little bit of the capital flows away from risk assets. So they haven't really talked about that for a reason. They want to land the plane softly. So they're easing their way into this. They're saying we're slowing down because we want to give what we've done time to work its way through the economy, which it really hasn't done. What the real risk right now, and a lot of analysts are looking at, is a potential for double peak inflation. So a lot of people are looking out for that. Some people don't think that we're going to have that. Some people expect inflation to recede rapidly. But we have a strong labor market. We have an easing of mortgage rates with the 10-year dropping like it has. Mortgage rates are now at 5%. So that's going to spur the housing market pressure. It's going to continue to put pressure on the housing market and spur activity there. The dollar is down. All of these things are inflationary and working opposite to what the Fed is looking for. So Powell was not very hawkish yesterday, but I think he's going to now come out and start walking back some of his comments. Some of the other Fed members are probably going to start walking back their comments because financial conditions have eased considerably. The markets are very robust. Investors are taking a lot of risk, and inflation is still stubbornly high. So the Fed still has a lot of work to do, and that's what Powell said yesterday. But the markets are betting right now that we're not going to see a real recession, that a soft landing is going to be doable. They're calling it the Goldilocks scenario, and that the Fed is going to be forced to pivot in the second half of the year. So that's what the markets are looking at. That's why we're seeing this action that we've seen. And of course, earnings from Facebook has really given to this rally, given fuel to this rally here. So here's the NASDAQ popping well above trend. This is going against what a lot of people had expected after the Fed meeting yesterday. And again, we talked about what happened the last time the Fed met. Markets popped on the 13th of December, then dropped after that. So we'll see what it looks like tomorrow. If some of this, unwinds, or if we get continuation. And if we get good tech earnings and we continue to get good earnings, then this rally will continue. and then the Fed will come out and probably the Fed speakers and members will start coming out talking tough talk to try to get the markets, rein the markets back in again. And then maybe you could see a little bit of the same kind of consolidation, which would be an indication that markets can try to find a bottom, that if the Fed comes out and starts talking the market down, maybe it kind of does one of these numbers, bounces around, and then kind of continues, and then, works its way setting, higher lows and higher highs, trying to reverse this trend. So the markets could potentially be trying to do that. The Dow's kind of ranging here, not really setting higher highs. These are a succession of lower highs here, but higher lows kind of coming together here. So interesting to see this kind of culminating in this little pattern here, and see what that looks like. S&P working its way up. So there's your low, higher low, lower high, higher lower high, but still obviously within trend. And when you take this and look at everything on a weekly, that brings it back into even more perspective. So let's get rid of these drawings here, and we'll take a look at, let's just remove everything here. Remove all the drawings, and we'll just take a look at what we've got here, and you can kind of see, high, lower high, still yet a lower high at this point, has not matched this high, and then lower lows up until this point. This could just be a higher low in this range here, and it could roll over and go on down. But right now, interesting times ahead, and earnings are going to weigh into this a lot in terms of what response is going to be from the Fed at the next meeting after the inflation print and how things look. But again, there's a lot of capital out there that has to allocate, and that's what's keeping these markets going, which is a good thing. It's keeping on pace with here we go, get rid of these right here. Well, I'll go back to that later. Keeping on pace with everything, keeping the markets elevated and moving. Here's Bitcoin. Now here's something on Bitcoin, still kind of stuck in this range here, not really able to break past this $25,000 level, which it really needs to do to look for any kind of continuation on Bitcoin. Let's look at the weekly, and here's the biggest thing right here. So Bitcoin has not been able to get above that 200 weekly yet. And the last time it lost, even popped up and then lost the 200 weekly, that went down to hit that 15,000 level. So, if Bitcoin cannot get above this 200 weekly, then it's possible that it could go down and revisit this lower level here, and consolidate for a little bit longer, putting in more of a macro bottom, macro base for this cycle right now before further continuation. So not able to keep the momentum going and punch through, even with the markets doing what they're doing. But this could have been leading the markets, that capital in here rotating out, going back into the markets with, hedge funds and investors kind of propping this price up right now. So it could just be a capital rotation. Here's the VIX trying to get a little bounce. We looked at the Dixie getting a little bit of a bounce. The 10-year, popped up at the end of the day here, but was down as low as 3.3% at one point during the day. And oil continuing its move back down to the bottom of this range here. So a lot of interesting price action out there. So, at the end of the day, what the scenarios are that everybody's kind of looking at is, maybe inflation has peaked. It's going to be coming down rapidly, maybe even back down into the 4% range below Fed funds rate. And, the thinking is the Fed won't get to a 5% level or get above inflation potentially before inflation comes down below the Fed's rate level, which would be a neutral stance. Of course, the Fed says they want 2%. So there's some thinking saying that we're going to get there by the end of the year, so the Fed can stop the rate hikes and potentially even start cutting rates if need be, if the economy is slowing. And the Fed did mention that they would rather risk over tightening. Powell mentioned he'd rather risk over tightening because they have tools to come back and adjust if they've over tightened. What they don't want to risk is under tightening. So what we could potentially be looking at is there's the rate hikes have not worked their way through the economy yet. We haven't seen massive job losses. We haven't seen a slowing of the economy. The economy is still robust. People are still spending. Labor market's still tight. So it's keeping a lot of pressure on prices, and inflation's not coming down very rapidly. So it's going to take some time for this to work out. So in the meantime, again, there's a lot of liquidity out there keeping the markets afloat, keeping things going. So the markets could potentially try to carve a bottom out here if, at least a temporary bottom until we get through, more of the year to kind of determine whether or not we're going to see any real recession issues in the market before we get into the next half of the year. So these are the things I'm looking at. This channel, if you're new, is all about entrepreneurship, real estate investing, real estate development, markets, crypto, buying business, starting businesses, anything and everything entrepreneurship. That's what I talk about. That's what I teach. I've been an entrepreneur since 1997 full time, and I'm a macro investor. I am not a technical analyst, in case you didn't notice. But I use the charts just to kind of spot trends so I can make my decisions on the market cycles, the momentum of the cash flow and liquidity in the cycles and things like that. So that's the main reason I use it. I'm not an hourly or a minute by minute kind of trader. I'm a shorter range trader right now, longer term when the markets are in a bull market, shorter term when the markets are in a bear market, and very difficult to trade bear markets. But you can have some good moves there. I don't do any leverage positions, long, short, anything like that. I'm just buy and sell. It's kind of what I do, and kind of how I make my moves. So that's what I use the charts for. And again, that's what this channel is all about. It's all about everything, anything and everything entrepreneurship, generating cash flow to invest in other assets, protecting wealth, growing your wealth, sustaining your wealth, things like that. I talk about mindset, leadership, all kinds of different things. So check out the playlist. I've got some really good content there. And of course, I have courses, mastermind and coaching programs if you're looking to take everything to the next level. So until then, I'll see you on the next video.